It's the new year, and so it's outlook season where all of Wall Street analysts, the strategists, they come out in December, early January, and they make their predictions for the S&P 500 for the year. And with that, I wanted to look back at prior years and see how accurate have they been. What I did is each year I looked at the range of predictions and then the actual number that the S&P returned. And so I think that I was really nice to the Wall Street strategists because I took the highest and the lowest prediction. So what does that look like? This is just an example of 2025 data. On the high end, I use Wells Fargo's number. And then on the low end, I use the UBS number. And you can see that there are lots of different predictions everywhere in between. This is 2025. And what that means is I use those numbers to create these bars. So every single year, I looked back at the last 8 years and created these various bars. And then I overlaid it with the actual results. That's what's represented by the orange dot. And what I find so incredibly fascinating is that from 2017 to 2024, the orange dot was not in the range of the most optimistic and most pessimistic forecast. To me, that's just incredible because we're taking all of their forecasts, the most bullish, the most bearish, and for 8 straight years, the actual was not even in the range. And you can see that based on different macro and micro trends, these ranges differed from year to year. You see a lot of really big up years, and then you see a lot of down years as well. And, to kind of be fair to them, I would probably always just guess we're going to hit the long-term average rate of return, which, depending on how you look at it, is anywhere from 8 to 12%. I think that's what a lot of people assume happens. But really, there's so much randomness in these stock returns. Every year, you really don't know what you're going to get. We can predict as much as we want. I was a little tongue in cheek in my newsletter on this topic. I said they pontificate and prognosticate on what this is. It's all just guessing, but they try to make it as complex as possible, really so that you need them, right? And in actuality, the results are all across the board, and these types of things cannot be predicted. The only thing that I see, just going back to that slide, is that more dots are above the x-axis than below them. And when you actually look to see what that looks like, you see that there are more positive returns than negative returns. And that's really important because that's how the 8 to 12% average return is calculated. In this red here, we're looking at where the S&P 500 return falls between 5 and 10%. And so I think that's super interesting. There are not that many that even fall in the range. I looked at a dimensional, I linked it in the article that I wrote, which I'll have in the comments, but I think it was 6 out of the last 93 years has the return been plus or minus 2% of the long-term average. So while we all expect this 8 to 12% return, it rarely is that in a year itself. It's usually higher or lower, and that's just how the average comes out to be. So enough on that. Really what I wanted to show here is the volatility. So stocks are volatile, and it makes some people get off the ride, so to speak. And that's just the worst thing that you can possibly do. The reason I share all of this is because I have no idea what's going to occur in 2026. I'm rationally optimistic and I'm generally neutral. I'm not going to make any predictions because I frankly think that if I made predictions, we would need to act upon them. And I don't want to do that. If you look back at the range of forecasts, I've got to believe that people at those banks were acting on those forecasts. And I just don't think that they're probably in as good of a place as they could be if they just let the market work for them and rationally diversified across the globe. So what I wanted to show here is volatility in stocks is normal. The blue, diamonds represent the lowest the S&P was intra-year. And so you can see a lot of these blue diamonds in here. And that just means that at some point in the year, the S&P 500 was down a certain percentage, but the bars represent where they ended up. And more often than not, they're in the positive territory. The market gives us these opportunities, so to speak, to get off of the ride, to stop investing, stop being prudent almost every year. And then every 3 to 5 years, there's some big drops in here, and the market even closes negative. We've got to stick to our long-term plan. So I say all of this to really just educate everyone on how volatile things can be, but yet still have such a great average over time. Now, just real quick, I love the Vanguard Advisor Alpha study. I don't think that it applies to everyone, and certainly not in the percentages that Vanguard attributes. But the whole idea is that working with an advisor could potentially give you a positive 3% or more in net returns. And there's a lot of reasons that they walk through how that might work. We've talked about a few of them, but investment selection and suitable asset allocation, rebalancing when things are volatile, just being prudent about the location from a tax perspective, all these things can really help. But the biggest things here are the tax loss harvesting, which you can only really do when there's volatility, where you're selling at a loss, booking that from a tax purpose, rebuying a similar asset. And then the other one is behavioral coaching, 2% or more. So if you're paying a 1% management fee, which is kind of the average in the market, this is basically saying that all else equal, you can potentially get 2% more from behavioral coaching. Basically, someone who's educating you and ensuring that you don't make those big mistakes. And those big mistakes, they happen every few years. I mean, like I just said in the last slide, every year you have the opportunity to make mistakes, but not everyone feels the pain enough to do it, I guess. But if you look back at 2020, when the market's down 30% in a month, or even 2022 when stocks and bonds were down, 2018 was a bad year as well. And then not even to mention the '08 crisis, right? So there's a lot of opportunities to just really make the mistakes. So I really love that. I think behavioral coaching, it seems so trite that, I would need to help be the intermediary between you and the market or whatever. But at the end of the day, we've all felt it. Investing is super emotional. We get anchored to our net worth at a particular time. And so I do think that it's really helpful to have that third party there with you along for the ride. And that was sort of the technical research-based information behind it. And basically, those results can be shown here. The numbers change all the time. But the idea is that a lot of times investment returns are higher than investor returns. And it seems really similar, right? But basically it's if you took the S&P 500 and someone investing solely in the S&P 500, it would show that over time, these 10-year rolling periods, by poor timing, investors are shooting themselves in the foot and they're getting in and out of the market at the exact wrong times. So they're feeling that FOMO, that fear of missing out when there's elation in the markets, and then the fear when markets are just down. I think that's super interesting. We can look at all the data, but this is really to sum it up, what tends to happen in those environments. We can't help ourselves sometimes. Last thing I'll say is that I don't know where the market's going in 2026. I would argue that you don't need to know, right? But what I do know is that over time, the market has been positive. And why is that? Well, capitalism at its finest, people working to better their lives, so much ingenuity of people at these companies coming up with new products and services and technology all the time to just better our lives. And the earnings of those companies go up, and therefore the stock market does as well. And so you can see here that your gains increase with your holding period. And what I love here is that you never know what's going to happen in the short run. Really, anything could happen, right? We're all investing and we are making bets on the future, and the future is hard to predict. But over the 5+ year time frame, we can see that returns have been positive in many of these periods. And so that's all I had today. Just wanted to give you guys my outlook. You're going to hear the media talking a lot about what you should think, what you should do. They may explicitly tell you, or they may infer it. But at the end of the day, you don't have to make any moves based on that information. So I hope that helps. This is obviously for educational purposes only. For my clients, we're going to be looking at your individual situation and we can further discuss. But for the masses, I'm trying to put this out to help as many people as possible. It should not be viewed as specific tax, legal, or investment advice. Consult your professional. If you'd like to learn more about my firm, Refined Wealth, and how we work with our clients, feel free to book a discovery call on my website. Would love to meet you, learn more about your personal situation, your goals, where you're at, what you're trying to accomplish. And I'd be happy to give you a free assessment. It's something I do for all clients. It's really just to get an understanding of how we're going to work together, the optimizations that I see in your situation I might be able to help you with. We'll spend 45 minutes getting to know each other, figure out if we might be a right fit, and then we can go from there. All right. Thanks so much.